Hello, this is Introduction to Search Funds. This topic was super interesting to me as to what is search funds, what is entrepreneurship through acquisition. And so I took a 2 day weekend course and by Professor Jan Simon, and I learned a lot. So let me summarize some of the key takeaways and learnings that would help anyone get a quick intro, and most importantly, I can revise this when I watch this video again. So the very first topic here is the people that took this course and that came and shared their experiences was just amazing. So Professor Jan Simon at Berkeley taught this over a 2 day period, and this is the summary of day one of my learnings. He brought in Mario, who's had a phenomenal case study that we had studied about him, and he shared his experience. Hannah Greenberg, who's also co-teaching courses at Berkeley, and she's had really good success in her search fund. Tim Foran, and who's also had success with an accelerator type of search fund. Hannah did a traditional search fund, and Jessica as well. So several people who have actually done search funds were called in, and that was the beauty of this class. A lot of real life experiences were shared. There was a lot of reading in the class as well in terms of case studies, and these case studies were awesome because you get to learn a lot about what is like the basics of search funds. You get to learn pros and cons. So in the very first one, we learned about different alternatives of paths that exist in a search fund. So you have a traditional search fund, you have a sponsored search fund, and a subvariety is an accelerator search fund, and you have a self-funded search fund. And typically the process goes like this. But before we go to the process, who is the search fund for? Search fund is for someone who wants to be the CEO. That's it. If you want to be the CEO faster, maybe you want to look into search fund. So that is what got me into looking at this. And what are the steps? Typically, a lot of people, when they are working in a corporate setting, they take a lot of time to get to the CEO role. I would say maybe 10 years, 10, 15 years if you're in a publicly traded company. That's the minimum, I think. And so there is a faster path to becoming the CEO, and one of that is search fund. So typically what you do there is you gather in the very first step a set of investors that would want to invest in you and invest in a company that you would acquire. So that's the key insight, right? Like the very first step is for you to gather those investors. Then you would start to find companies that are ready to be acquired, and that is the M&A step. Then you would raise the money from those investors. So which investors you attract is important, because at some point they'll have to pay big amount of money, like $400,000, $500,000 per investor. If you want to, let's say, raise $15 million, you need like 15, 20 really high profile investors who are willing to put away $500,000, $400,000, which is a lot of money for one single bet. So acquiring and gathering your investors, doing an M&A, finding a company that's ready to be sold, and figuring out your financing to raise the money. And because not everything will come from equity from these investors, you'll have to raise debt. Then you'll have to manage and hire a team that runs this company, and you become the CEO, right? So becoming the CEO is a big part of this, if you really are interested. At the same time, you get a lot of ownership opportunity. You get to have close to 25% if you structure the deal well, that you can eventually get to those strong level of ownership of the company and being an operator, which is the CEO. So there are different paths, pros and cons of traditional search fund. Traditional search fund is where you go through the steps above, but you are on your own for the most part in terms of getting the investors, sourcing, raising the money, everything, the whole flow, you're doing it. Sponsored is when you have a PE or a private equity or an accelerator backing you, where they actually will have a lot of expertise, team of experts already there. So if you want to raise money, they'll have a set of financing people ready with expertise. If you want to do an M&A, they'll have a list of companies that you can talk to like yesterday. So There are pros and cons. You can get started very quickly when you are in a sponsored fund, but you cannot really pick and choose which board will be your board, right? Because at the end of it, the board, if you're the CEO, the board, you report to the board. And it's self-funded. If you have all the money, then you don't raise money from investors. You just go on your own. So that these three routes for these steps that you can follow, and depending on your level of readiness, you would pick one of the three. And so, and all of this we learned from the case study, and the case study was so good, right? So reading materials were fantastic, and lots of questions to ask and reflect, like, hey, do you need a partner to do this together, or are you going to run solo? Do you have the skill sets? When is it a good time for you to do search funds, right? Are you willing to move to a place where this company is headquartered? Like a lot of these small companies, they might not even be where you are. So are you willing to move? Do you have the experience? Do you know what industry you want to go after? What area you're trying to go after? And do you have the experience to do the due diligence, raise the money, and all of that, right? So typically, this is the summary that I could create of this case study, which is if you have lots of money, lots of money, like at least 3 million in the bank account right now, savings, then maybe you should consider like search funds as a self-funded search fund. If not, you're better off to consider like, hey, do you have the skills to actually run this on your own? If yes, then consider traditional fund. If both the answers are no, then you should go for an accelerator or a sponsored search. So that was good, right? You need some way to make those decisions. But in a sense, what you're trying to do here is you're trying to buy a company with investors' money that you can have significant stake into. And when you do this round where you're trying to search the company, you can actually get paid. Meaning you're not just doing this without getting paid. You can get paid $15,000 to $20,000 a month, and you can raise $400,000 from these investors just to do the search, so that you can do the due diligence. You can do you can do those calls. You can prospect them. You can create LOIs. You will have lawyers looking at their paperwork and everything, right? So you'll have money to acquire, but you'll get 2 years to actually find this. So raising money is a big part. And then we did another case study, which was really interesting. Learned a lot about due diligence and the importance of how when the seller is not really responsive to selling, and that is where you'll have to have skills to say, hey, are you really trying to push for them to sell, or are they not cooperative for a reason? And remember, there's a lot of acceleration here now in this time of COVID, when a lot of sellers are under distress and they have had a lot of time to think around like where do they want to prioritize their life and time. And so a lot of them are trying to sell out. So this is a big opportunity where a lot of sellers are willing to sell, but at the same time, they don't want to sell their life's work. Think about this. This is their life's work, where they have set up this small business for a long, like 10, 15 years or 30 years sometimes, and they want to sell it to you. Why would they sell it to you when they have like a lot of people that are willing to take it? You got to have a lot of positives. You got to have a lot of edge so that they can sell it to you. So that was good. That was good learning. And remember this, right? There are 3 stages. First stage is searching. Second stage is acquiring the company. And third stage is running the company. So when you're searching, you need a different kind of skill. When you're acquiring, you need a different kind of skill. And you're running the company, you need a different kind of skill. Each has a different focus. When you're searching, you're trying to use all of your skills to do industry analysis. You want to talk to brokers. You want to do a lot of calls. You want to build relationship. You want to use your network. You want to use like various conferences, and you really want to get in front of a lot of potential sellers. You want to build that funnel, which is a list of people willing to sell or even maybe in the market. When you're acquiring, you need to check if the value exists. Is there an opportunity for you to double the revenue, double the EBITDA, and is there opportunity for you to add value, right? And finally, when you're running it and eventually want to sell it, you want to make sure that you optimize for shareholder value, right? In terms of how is this company becoming more profitable, much more better in terms of operations, and so on. But a typical funnel, which is an interesting that I found, is look at this stats. A typical acquisition, which is at the very bottom, a typical acquisition requires 3,200 connections 256 of them will probably, you know, respond to you if you connect that many people. And then maybe half of them will want to meet with you, so 125. And maybe one fourth of them will even tell you the price or willing to share more. And then maybe one fifth of that will you will want to engage in a letter of intent to acquire them, and possibly one you can consider that you can buy, right? So the funnel is quite deep, and the funnel is also quite sharp in terms of how it wedges out. So, but a lot of work is needed when you're trying to search, and a lot of different kind of skills is needed when you're trying to run the company, like operations. And the big insight here is, why is someone willing to put money on a brand new CEO who's never been a CEO? The reason why this works is that the investment is spread out, meaning investors don't have to put a lot of money just to start the search, right? Because it's like, let's say, $5,000 to $10,000 per person, and they can bet on you with the step up that they get. A step up is basically they get higher amount of equity or a higher percentage investment right into your company when you try to raise the money. So they get more. So it's a very low, for a lot of these high profile investors, probably it's a low risk situation, so they get higher return. But the reason why this works is that the barrier to getting a lot of distributed investors reduces the risk, so more and more investors can come in. And second, now this new highly energetic, capable leader who's never been a CEO is now surrounded by a board of investors who are really capable. So that's the combination. The board of experts surrounded by this new CEO, if he takes the guidance, if he or she takes the guidance, then that can really accelerate and move the company forward, creates value for the person themselves and also to the shareholders, right? So that was awesome, right? Lot of learnings in just the readings. We're just going through the readings, right? And when you're doing these calls, landing a meeting, the importance of the first meeting is to land a second meeting. Importance of the first meeting is also to check if the seller is a real seller. Importance of the first meeting is to check, why are they willing to sell? Is there a genuine reason? Ideally, it's health that is important, or there's financial distress, or something that is clear, right? Old age is a good one, health is another one, but you need a genuine reason. So very early on, you need to find out, like, hey, is this a genuine seller in the first meeting, ideally? Otherwise, you're wasting your time. And so 3 things: is it a genuine seller? What's the range? Are you even in the ballpark? If they expect 10 million and you are in the 1 to 2 million range, that's not going to happen. So get the range, check if there's a second meeting that you can set up, and it's a real seller. So great tips, right? Just from reading the case and discussing some of these cases in class. And you need 2 types of valuations. So you need a valuation that's aggressive, that you would build with DCF for your investors, and one for the seller, so that you don't oversell, that hey, you need to sell because there's so much value, otherwise they'll not sell. The seller may decide that if you're too convincing, that I might just do all the things that you want to do, and in the next 2 years sell you after the company has doubled its valuation. So it's a fine line of how you create these 2 valuations, and what kind of return you get out of this, right? But typically, the rule of thumb is valuations 5 times EBITDA acquisition, and you double the revenue, and so you double the growth, and then eventually you can sell or continue to run, and you will have a long ownership in the company. So those were just the readings. So that's the first 15 minutes into it. I'm going to continue for the next 15 and summarize day 1 learnings, which is even more interesting, right? So I covered in day 1 what we learned was around search and acquiring, like how do you search and acquire a company, and day 2 is about running and selling. So acquiring and searching is the most important part. So we're just going to cover search and acquiring in this video. So we covered some important terms that you would want to really quickly get familiar with, which is step up. What is a step up? It's a term that gives the initial investors um, some premium, right? In this case, it could be a 50% premium on the acquisition fund, and it could be some incentive for them to invest in your searching activity, the first step. And then what you do is you build a syndicate, which is a diverse slate of investors who are willing to bet on you becoming the CEO for a specific company that you would run in an industry, in a company, in a country, right? So that syndicate is super critical for you to build. And the benefits that you get, as I said, it's right here, 8% you get when you acquire a company, equity. You get another 8% when you run it well and you meet the targets. And then you get another 8% of equity when you sell it. So close to 25% you get as a CEO. So that is huge as long as value is created. So you might be wondering, why is PE, private equity, not into this space? It's too small of a ticket size. Typically, these companies that are being looked at are around 9 million to 20 million, right? Valuation. And so for private equity, that just doesn't cut it. They'll have to do thousands and thousands of such deals. So they're not going to be there. It's not in the food chain for them. And so there are different people that were brought in. Hannah, Tim, Jess, we covered in the very early stage. I shared some pictures of their LinkedIn profile. Amazing people. They shared so much interesting things. They all did different kinds of search fund routes. One traditional, one sponsored. There's also one person who's supposed to be coming. I think who's going to self-fund it, so we'll learn more about that. But there's risks and there are benefits, right? The risk of doing everything in a traditional is like too much money. You have to self-funded is too much money. Like you have to put up all of that search capital, which you may not find anything, right? And so that's a very expensive mistake in that sense. You also lose the opportunity cost of your current pay that you might be getting. A lot of these companies use MBA interns to generate the leads, right? Who to talk to, which industry, right? And Accelerator helps you with a group very quickly to set up a set of people around you who can help you, who are already an expert, and a set of board members. You can think about them, right? And there's a lot of experimentation you will do, and when you start the search, as simple as like email subject line experimentation changes so that people actually respond to your email. How do you do your pitch so that they are interested in having a second conversation? So much. What kind of tools will you use to actually follow up? Would you use a broker or not use a broker? Maybe you use a broker to find out all the dumb questions that you can ask them, right? And what kind of industry you will go into, which industry you will not go into, and which industry you'll go so that you can improve and then eventually sell. Who would you sell to, right? Lots of sellers in the market. And there's this report that I need to look up. It's called CNBC Research around COVID. So significant uptick in sellers. That's a good sign. Operator is a term that is a CEO. And so that, remember that the seller who's trying to sell is trying to sell their life's work. So they'll not sell to the highest bidder, which is what happens in private equity and many other places. They will have to sell to the largest bidder. Here, they are sole proprietors. They have the right to sell to anyone they want, right? And so remember the fact that when someone's trying to sell you their life's work, they have a lot of relationships that they have built over like 30 years of working at that company. They want to take care of the people. They care about the legacy. They take care about, they want to really care about the culture. They want to see it grow. They want to see it thrive. Maybe they want to continue owning some parts of it. There's so many reasons. So really deeply understanding the seller, the motivation, and having that culture alignment, that's where the value is created. That's where the arbitrage is, where you come in, build that trust relationship, and if you see it to be a genuine win-win for both, then you double down and you buy that company, and you will be sold that company. Even if there is someone bidding higher from a PE side, you will get that company, right? So in a sense, you're also selling yourself and your skills. Like, you would want to be CEO ready, which is another key learning, which is, are you ready to be the CEO? And some of this experience actually teaches you to be CEO ready. So that's another key insight. Like, when you're searching, you're actually getting better and better. But it is intense, right? Because you never know. You don't have structured work. You're going to completely have unstructured work. You'll have some cadence in which you would respond back to your investors around your learnings, progress so far. But a lot of it is self-driven, right? So this is very self-driven process, and finding an industry that is really good and has a B company, that'll help you, right? The next step is due diligence. Due diligence is a really interesting topic. You want to find out ways in which you understand everything about the company. There's going to be the iceberg at the very top, where you will talk to people, the customers that they want you to talk to, the seller. There'll be people, things will be presented to you accounting wise, employee wise, and others, which are the best foot forward, right? But due diligence requires you to go dig deeper, like talking to former employees if possible, talking to competitors, customers who left, employees who left, right? Former employees. Doing the due diligence is super critical, right? But this all happens only if you are truly CEO ready, meaning you want to be the CEO. You may not be ready, and that's okay. That's what's the biggest learning, but you really want to be that. So that's the key requirement. So a lot of self-reflection as to why you're doing it, what's the purpose, how are you gonna get the support that you need from your family. It's super critical to do this. And once you have this, you raise 400,000, let's say, for a solo search. But if you have a partner, you can raise 700,000 for the two of you, which is around $15,000 to $20,000 a month, and you get 2 years to do this. As for next steps that you could take, is you could do an internship. You could be that one of those MBA interns who could actually help one of the search funds to generate leads and find out how they do what they do. You can go to conferences. You can even sign up for some part-time work. Then eventually you can jump in. So super important learning in terms of how do you take the next step. There's also a book coming out by the same professor, Jan Simon, in December this year, 2021. So I'm looking forward to that one. He shared this amazing list, characteristics of a good searcher, or what are the characteristics of the people who become really good in terms of search funds and being the CEO in this specific niche. First is that person would have done a personal due diligence on why they're doing what they're doing. Why do they want to do this, right? And they're humble, meaning they listen very well. They're hungry, they have big ambitions, and they want to, basically they're saying, hey, look, I can displace this person who has 30 years of experience running this company. I can actually do a better job. Comes if you're hungry, but you also need to be humble, because otherwise you really don't know the business. You'll have to build that expertise very quickly. Being honest and ethical, and these are all H's, right? If you look at the first character, it starts with an H. So these are all the characteristics that he listed out one by one in a whiteboard. It's amazing learning. So positivity, energy, and happiness, and someone who has less hurdles, meaning less conditions in acquisition, because sellers, these are don't have those skill sets. They don't have those skill sets to actually buy those companies. And so, these people want to have less hurdles, right? And so these are the really good characteristics of all the H's all the H's for a good searcher, right? So look at that list. It's pretty amazing. Cool. So another key thing that I learned was there are different types of searchers, and there are certain quadrants, Q1 to Q3 to Q4. Q4, if you are a Q4, this person will never be a CEO. So if you are that, then, stop. But if you are a Q1, Q2, or a Q3 quadrants, searcher, then you have a chance to become a Q1, Q2, Q3, or Q4. Meaning the top three quartiles actually can get, there's a various distribution as to who and how successful these searchers become, right? So that was a key insight, meaning when you are in the business school, you go through this behavioral transformation, which is the biggest and the hardest thing, which is what Professor shared, which was a really good insight. And he also shared that, hey, the intersection between skill, what the world values, and your passion is where this happens. A lot of self-reflection. But he shared this insight, like even if you're a Q3 searcher, you can become a Q1, right? And so that was a good insight, because the journey transforms you. But you'd have to stick it out. You'd have to be the CEO ready material. It's not a set of check boxes that you tick. Otherwise, everyone would have become a searcher. But it is the transformation of the behavior, or going from structured learning to unstructured learning, being on top of things, working with your partner if you have a partner. And remember, that partner will have a huge role to play, keeping you honest, working with you crazy. This is not a 0 to 1 startup ecosystem game. This is a 10 to 100 scaling ecosystem game, but there's a lot of hurdles to actually just get the company seller to sell you. And the time right now, post-COVID, is right for a lot of these small businesses that are wanting to sell. And what do you now look at in these companies? What characteristics would you look at in the company that you're trying to buy? What company characteristics? First, recurring revenue. If you have a lot of recurring revenue, then the product and the offering is sticky. People will not go away. The customers will not go away. You want repeat revenue. You want low churn. You want... it's okay if there's seasonality, but not cyclicality. You need high gross margin. You need the growth industry. You need good business. Don't go after turnarounds. The odds are stacked against you. A lot of experience is needed for anyone to bet on you for turnarounds. Not worth it. And you need to have the convincing power for the seller to sell you. And so remember, venture capital expect 20% return, private equity 12, 14% long term. That's what they have returned. Search funds between them 14 and 20%, right? And so a fragmented market is a good space for you for the company to look at, because then you don't have a dominant player, and you can actually don't have to deal with all of those pressures that come from a dominant player who has a cost advantage, scale advantage, and so many more, right? Avoid M&A, which has a turnaround aspect to it, which is and typically M&A deals like 20 to 30%. Only that's the success rate of an M&A. So you want to, with this search, it's also an M&A, right? But you want to greatly increase that by doing a lot of this check mark in all of these areas, and you're looking into this space where no one else is looking. So that's the key, and you have an advantage so that the seller wants to sell to you. And he shared also this really good curve as to where and how these players are playing. And he said that the fragmented market is where the search funds play in, and post that you sell. After you've really grown the company, you sell maybe to the private equity. IPO is a very rare thing because it requires huge growth. And so then fragmented search fund market, and then private equity. Big mature markets are big companies play at the very long and at the very high end of this. So M&A happens because of strategy, which is one key area, like P&G buying Gillette, right? They get market power, right, from Costco's of the world. Bonvoy with 30 Marriott brands, they get market power against Airbnbs. So strategy could be one part of M&A. Second part, he said, was finance, another part of M&A, wherein you create valuation synergies, improve because of valuation increase, and then leverage. You can borrow up if the company has that buffer. And integration and execution is another area where M&As play out pretty big time. So typically it's a 1 to 2 million EBITDA company, and you buy them 5 times that, so 5 to 10 million is the typical range. And there are 2 different models, Harvard model and Stanford model. Harvard model is more like the self-funded, predictable cash flows, more opportunistic. They'll take any industry that's willing to sell. And Stanford model is more like optimize on the growth, and looking to make the company grow faster. They're more targeted. The investor is also going to be very different. The self-funded is more the Harvard one. Search, traditional, accelerator, they're all the Stanford model. And these two colleges, they have like a lot of conferences as well, which are pretty interesting to check out. All right, so that was day one. What a wrap. A lot of learnings. Thanks.